want to be in a great hurry. We want to learn from the experiences of the way the projects, the pilots are running. There will be some technological challenges. There will be some process challenges. We want to iron out all those aspects and introduce it in a manner that the whole process, the whole introduction and thereafter is non-disruptive. Similarly, second point I want to mention is that based on the learnings and experience of this end-to-end digitized KCC loans, our endeavor would be to launch it in a full-scale manner, everything going all right, not only for the farmers' loans, but also for the small and also for the SME loans. And if everything goes all right, we hope to do that, launch it on a nationwide basis sometime during the year 2023. I'm not referring to financial year, I'm referring to the calendar year of 2023. Of course, we are working closely with our banking partners. In fact, it will be extended in due course to all the banks. Currently, it is being done by 2 banks. 2 more banks are about to be onboarded very shortly. The banks will have to upgrade their technology simultaneously. And what is more critical is that the state governments also need to completely digitize their land records and the process of verification of the title, so that the title verification process also is simplified. Good morning, everyone. Shri Sanjeev Mehta, President FICCI, Shri A.K. Goel, Chairman IBA, Shri Sunil Mehta, Chief Executive of the IBA, other dignitaries on the dais, members of FICCI and IBA, friends from the media, ladies and gentlemen. What I mentioned earlier was by way of a starter. Now I will get into the main course. I'm happy to be here. And I'm also extremely happy to have been invited to this annual FIBAC 2022 conference. I distinctly remember that I was here in this hall participating in the FIBAC 2019. That was 3 years ago. So therefore, I am doubly happy to be back after a period of 3 years. Now, this is an important forum for the banking industry as well as for business. We have the presence here of thought leaders, banking practitioners, stalwarts from the industry, and several technology players, some of whom have put up their stalls just outside this hall. So I'm extremely happy and delighted to be in a gathering like this. Now, this conference is being held at a time when the global economy is going through a process of churning. Triple shocks of COVID-19, the war in Ukraine, and the current financial market turmoil have created a toxic mix of factors and circumstances which every country has to grapple with. The International Monetary Fund, in its recent annual meeting, has presented a rather somber outlook for the world economy and the world trade. And it has also gone on to make downward revisions in its growth projections for the current year as well as for next year, and also downward revisions in the volume of global trade. The existing international order is undergoing fundamental shifts in terms of geopolitics and economic relationships. Now, the confluence of these factors and circumstances is reverberating speedily across jurisdictions through various modes and spillovers. With monetary policy actions and stances undergoing a regime shift in the advanced economies, financial conditions have tightened sharply across markets and have accentuated financial stability and have accentuated what I call, financial stability risks. Emerging market and developing economies, that is EMDs in particular, remain highly vulnerable to these global spillovers. Capital outflows have led to reserve losses, sharp currency depreciations, and spiraling imported inflation pressures. And this has happened across EMDs. Several countries face acute debt distress, while many others are confronted with elevated food and energy prices. Conventional and technocratic policy making is increasingly getting challenged by unconventional and out-of-the-box approaches. In this unsettling global environment, the Indian economy has been growing steadily, drawing strength from its macroeconomic fundamentals and buffers. According to the IMF, India is slated to be one of the fastest growing major economies of the world in the current year as well as in the next year. Our recovery and growth have been more broad-based. Our policies, fiscal, monetary, and regulatory, were prudent, targeted, and time-bound. We were careful to ensure that demand remained in balance while supply conditions improved. As per the high-frequency indicators for the recent months, and in Reserve Bank we monitor nearly 70 high-frequency indicators on a real-time basis. Now, as per these high-frequency indicators, especially for the recent months and the weeks, we find that private consumption, especially urban demand, has remained quite healthy. The contact-intensive services have continued to make smart rebound, and aided by unfettered resumption of activities and full-fledged celebration of festivals after 2.5 years. So you see huge amount of participation we all saw during the Ganapati festival in Maharashtra and other places, and also during the Diwali festival. And as the data is trickling in and flowing in, we find that the sales of various, the overall retail sales of various goods, the white goods and other fast-moving consumer goods have also improved considerably. Now, amidst all this, external demand, however, remains a weak spot in the face of accentuating global economic slowdown. Domestic inflation remains elevated. We are closely monitoring the inflation trends as well as the effect of our past actions. In our view, that is in Reserve Bank's view and in my view, price stability, sustained growth, and financial stability need not be mutually exclusive. In the Mahabharata, during the famous Swayamvara, when the great warrior Arjuna was aiming at the eye of the revolving fish, there was a fish and the fish was revolving during the Swayamvara. I'm quite certain, and he was looking at it through a pool of water which was underneath. I'm quite certain that he would have certainly assessed the speed at which the fish was revolving, the wind conditions prevailing, the intensity of the ripples in the pool of water below, the noise levels in the king's court, and similar other factors. No one can match the prowess of Arjuna, but our constant endeavor is to keep an Arjuna's eye on inflation, which is our primary target. At the same time, we keep assessing other related factors like the evolving inflation growth dynamics, soft indicators like our surveys of consumers and surveys on consumers and businesses, global macroeconomic, financial and commodity market developments, and aspects of financial stability. In other words, our policy measures are based on an assessment of the overall situation. We will continue to steer our policies accordingly. In this direction, our continued effort is to put in place strong institutional frameworks to ensure a sturdy and resilient financial system that would be ready for the challenges in the future. Let me highlight what I have done is actually I have highlighted about 5 specific areas, but I will not read out that part of the speech. I would rather, speak in a more informal and in a more conversational manner. And the 5 areas are, the first area is basically, I've talked about the monetary policy framework and flexibility. As I have said earlier on several occasions, and as our various publications from the Reserve Bank have explained from time to time, during the pandemic, we utilized the flexibility embedded in our monetary policy framework to tolerate a slightly higher inflation, but within the range of 2 to 6%, to ensure that the economy, overall the economy, remained resilient and financial stability was maintained, with a clear objective that when situation normalizes, we will bring down the inflation to 4%. Now, in the process, today, we are in a situation where, the inflation has remained above 6% for 3 consecutive quarters, and under the accountability norms which are provided in the Reserve Bank of India Act, we are expected to send a report to the government explaining explaining as to why it happened, what measures we propose to take, and by which time we expect inflation to come within the target range of 2 to 6% and closer to 4%. This is what has been provided in the law. We are having a monetary policy meeting tomorrow. There's a lot of media reports and a lot of speculation about the whole process, because this is the first time India is experiencing something like that. The Bank of England writes this letter almost every month for the last 1 year or so. There are other central banks which also write similar letters. For them, it's not the first time. But in our country, the inflation framework itself is pretty recent. It was instituted in 2016. So the MPC will meet tomorrow, and we will prepare a report, and we will send it to the government. There is also some amount of speculation about what the Reserve Bank will write, and some people have gone on to conclude, based on what I replied in a post-monetary policy press conference. They asked whether the RBI will release it. I said, no, the RBI will not release it. It's for the addressee, the government, to decide and do the needful in this regard. Now, questions have been raised about transparency of monetary policy, transparency of what we are doing. This is such a sensitive bit of information. How can RBI keep it under the wraps? The entire monetary policy framework, which was instituted in 2016, is based on very strong principles of transparency. The minutes of the meeting are released as soon as the meeting is over. The minutes of the meeting, the resolution of the MPC, it gives out what are the decisions and why those decisions have been taken. After 2 weeks, the minutes of the individual members are also released, so that everyone knows who said what and how it facilitated a decision making. So the expectation is that since we release the monetary policy resolution on the day of the MPC, why don't we release the letter itself also on the day of the MPC? You see, I just want to place before you for consideration, and I would like you and the others who may be listening to this this speech through the RBI YouTube channel. And let me say that the RBI YouTube channel and other social media platforms are also, live streaming this for the wider audience, especially from the financial sector. You see, the MPC resolution is meant for the entire economy. Immediately, the market should know what is the RBI's decision. Citizens of the country should know what is the RBI's decision. Unlike that, the letter in the case of a letter which which the Reserve Bank writes to the government, it's a report sent under a law. I don't have the privilege, the authority, or the luxury to release a letter like this, which is written under the law as per the legal requirement. I don't have the privilege, authority, or the luxury to release it to the media before even the addressee gets it. There's so much of communication which goes on between the Reserve Bank and the government, both ways. We don't share each and every letter. But that is not to assume that the contents of this letter and the report are going to be perennially, under wraps. They will be available in the public domain at some point. So the limited point that I was making, and I don't want to be defensive about it because that is the legal position. I have no authority to just write a letter to government and then release it to the media. It's not like, in the political space, for example, there are leaders who write a letter to the government and immediately release it to the media. That is for a different purpose. Here, the first right of receiving the letter lies with the government. The addressee should get it first. In due course, sooner than later, it will be out. The Parliament will know about it. The Standing Committee of Parliament will know about it. It will be really, the contents will be known. So it is not as if there is transparency being compromised in any manner. And I want to say it very emphatically that the monetary policy framework instituted in 2016 is a very transparent framework, and the writing of the letter is also very much an essential and fundamental element of that transparency. Nobody is hiding anything from the public, but it's a question of time. And I think it should be seen in that context. In fact, I can say that the framework itself, we give it a lot of importance. When the framework had to be re-notified in 2021 March, in 2021 March, for the next, starting 1st April 2021. There was speculation, and in fact, there was some argument in certain sections that the target itself should be, increased. The median point, instead of 4%, should be 5%. In fact, people have also questioned the necessity of a framework for a country like India. But we stuck to the framework which was instituted in 2016 because it was instituted after a lot of consideration and a lot of research within the RBI. And the RBI research showed that the mean point of 4% has its relevance for maintaining overall macroeconomic stability and for supporting growth. And any inflation above 6% can be detrimental to growth. So the whole purpose of having an inflation framework for the convenience of the people, for keeping prices low for the people, or for ensuring financial stability and economic growth, the purpose would be lost. So therefore, we reiterated the importance of continuing with the target, and we were very happy, and that the government also appreciated our point of view. The government agreed with our point of view, and they have re-notified it. So on the first aspect I have highlighted here is with regard to, I have said few other things about our forecasting methods, about digital rupee, etc. I am not going into the detail of it. The second aspect which I have highlighted is that the second component of our effort to ensure financial stability is to bring about systemic changes, to bring about reforms in various key segments of the financial sector. During the pandemic and during this entire crisis period, the Reserve Bank continued to work as if it was normal time. It was, in fact, for Reserve Bank, our working hours, at least for the top management for the first year, and thereafter almost for everyone, it was business